Good afternoon, ladies and gentlemen. I am Kamlesh Tejwani, your host for today's webinar. It is my pleasure to welcome you to this insightful session focused on the upcoming new fund offer by Invesco Asset Management India Private Limited. This AMC boasts assets of over 86,000 crores and offers more than 80 mutual fund schemes here in India, catering to a diverse range of customer needs with a global presence in over 120 countries and assets under management exceeding $1.7 trillion across the globe. Invesco is a formidable name in the asset management industry. Today, we are privileged to have with us Mr. Dhiman Kothari, a seasoned professional and fund manager at Invesco India AMC. Mr. Kothari is a chartered accountant with over 20 years of experience in equity and research. Since April 2011, he has been an integral part of Invesco India, managing various equity schemes, including Balance Advantage Fund, Financial Services Fund, ELSS, PSU Equity Fund, Multi-Cap Fund, Aggressive Hybrid, and so on. So on that note, I welcome once again Mr. Kothari. Mr. Kothari, we are eager to hear from you about the new product, the Invesco India Manufacturing Fund, which is set to launch next week. So without further ado, I invite you to enlighten us with your new exciting offering in this space.
Thank you, Kamlesh, for this kind words and inviting me to speak. So, good afternoon, everyone. Let me without much ado, let me straight away start with the agenda. So, before we get on to the manufacturing fund and what we are trying to offer, where's the opportunity over there? Let me just set the context right in terms of the macroeconomy, what the India has been currently going through. And on that context, let me then go on to the main agenda of the thing of the evening today. So I'll just take you back to 2011 to 2020. That was kind of a lost decade for us in terms of the corporate earnings. So there were various reasons. 2008-9 global financial crisis struck us, and from that it took us 4 to 5 years to recover from that. We were going through some slowdown in the economy. So that is where the start portion of the 2011-20 decade started with. We had very high fiscal deficit. That was another challenge. 3, we were grappling with few of the scams and Supreme Court cases relating to that, something like coal scam or the 2G scam. There were NPS being built up in the banking sector. On top of that, the corporate balance sheet was also very leveraged. And that was, of course, the outcome to that was the NPS of the bank. So the banking balance sheet was weak. The corporate balance sheet was weak. The government balance sheet was weak. As I said, the fiscal deficit had touched almost 8.5% if I were to include the off-balance sheet items like oil bonds. So that is where your economic setup was during the start of 2011. Middle of the decade 2014-15, the government changed. There were various hopes on the new government. But again, having said that, the government was already loaded with high fiscal deficit, so they couldn't spend much. So the FRBM Act, as you will be aware, it requires the fiscal deficit to be brought down towards 2%. So the new government was also loaded with this. On top of that, there were few decisions which were taken or the few resets which were made to the economy, which brought some slowdown to the economy or some disruption to the operations of businesses. One being, of course, demonetization. Many businesses suffered because of that. Whether it was a good move or a bad move, keep that aside, there was a disruption and the businesses suffered. Second was the implementation of GST. Of course, it's a good and a welcome move, but as you know, because of the taxation change and the regime change, usually there is a disruption in the business. The businesses grapple to come to terms to the newer setup or the new scheme of things in terms of taxation. Third, what we saw in 2018 was INFS led crisis, the NBFC crisis, and eventually there was a near collapse of Yes Bank, which was eventually bailed out by SBI and others. And finally, in 2020, we had COVID. So over last 10 years, since 11 to 20, there were many such small or big accidents and the economy couldn't recover. The corporate earnings, if I were to just proxy that with the Nifty earnings, they just grew by 4 to 5% CAGR during that decade. During that decade, in fact, that was a narrow market kind of a rally. The broad market or the broad portfolios hardly managed to give returns which were close to FD kind of returns, and there was a competition between FDs and stock market returns. So that was the kind of dull period what we were going through. Various other ingredients were in place in terms of young age population, the demographic dividend, that narrative, the under penetration story was always there. So we tried to manage to come back, but because of this various series of events, we couldn't manage to capitalize on our strengths. Now, come 2020, COVID came. It was unfortunate, of course, but many things fell in place after that. Not just because of COVID, but yes, of course, because of passage of time, because of various regulations in place. So, for example, banks gradually cleaned up their balance sheets. The IBC, the bankruptcy code. So the insolvency and the bankruptcy code had come into play. So gradually the banks were cleaning up their balance sheets. The corporate India was cleaning up their balance sheets. And it coincided that by 2020 or 2021, the banks and the corporates managed to clean their respective balance sheets. Gradually, if you notice, the third balance sheet, which I spoke about, was the government balance sheet. Fisk, we gradually brought it down towards 3.5% in terms of deficit by 2020. But the same FRBM Act allows the government to move up the fiscal deficit if there are critical events like civil war in India, or some global civil war, global recessions, pandemics, or some natural calamities, including floods, so on and so forth. So of course, COVID was a pandemic, and the government took advantage of that in a positive manner. In 2021, of course, there were some freebies from the budget in terms of your free food to the poor, uh, some bit of interest subvention schemes to the MSMEs, which was of course required. Like human being required vaccinations, the economy also requires some bit of vaccination. So those were very much relevant. It was very much necessary to support the bottom of the pyramid, and that is what in 2021 government did. Come 22 onwards, the government shifted the focus to infrastructure and capital expenditure. That is where your we are today, we are seeing the defense and the railway books are soaring now. So the spend on the defense, spend on the railway has been increasing. So that is what government did, that took advantage of this allowance given by FRBM and took up the fiscal deficit to 10% initially in 21, and gradually they have brought it down towards 4% as well. So relatively now the government balance sheet is also good. But more importantly, the fiscal deficit, large portion of that is explained by constructive capital expenditure. So there is nothing like freebies or goodies which are being given. So that was one advantage of COVID. As I said, balance sheets of banks and corporates anyways were in the process of repair all through the last decade. So that also coincided. And thirdly, the importance of Make in India took took a sharper focus. Right, this government was always talking about Atmanirbharta, Make in India, but in 2014-15, when the balance sheets were not right, the borrower balance sheet and the lender balance sheets, at that point of time, of course, you did have that challenges in terms of corporate not spending. the private sector capex had almost stalled or was very lackluster at 5.5 billion USD. Now on the margin after 2020 that has started to move up, and now it is like 8.5 billion USD. So many things changed after the COVID. The organized segment became more organized. They gained strength over strength. The unorganized segment is losing, and the pace of loss of the unorganized segment has been accentuated by COVID. Of course, before that as well, as I said, there was implementation of GST and demonetization that had also weakened the unorganized. And anyways, banking sector was not able to lend in the last decade entirely. They also focused on the larger corporates, and that therefore meant that the MSMEs was neglected during 11 to 20. So the small became smaller, then the organized segment grew strength to strength. So what therefore that has resulted into is corporate earnings have started moving up in a meaningful manner. Yes, Indian GDP is cruising around at 7%. And if you add 5% of your thumb rule of inflation, of course, inflation today is down, but if you include 4 to 5% of thumb rule inflation, usually our ballpark nominal GDP grows at 12%. And the corporate India profits grew by 15 to 16% from 2019 to 2024. Why I am not taking 2020 or 2021 as a base? Because of course that is a weaker base impacted by the COVID. So if I look at 19 to 24, then the corporate earnings, again proxy is Nifty EPS, grew by 15% CAGR. So that is where the economy has started to see strength again. The balance sheets are pristine again. As I said, both the government, all the three balance sheets, the bank balance sheet, the corporate balance sheet, and the government balance sheets are in a good shape. And that therefore triggers a big economic cycle, upcycle again. The reinvestment cycle has started, the capex cycle has started, and it has now more legs to go because there is no challenge of NPS or leverage on either of the balance sheets. So in that broad context, what we have therefore bringing up is the manufacturing fund. So let me share the slides on the manufacturing fund. Yeah, I hope my screen is visible.
Yes, it is
Yeah,
visible.
sure. Thanks for alerting. So, as I said, our thumb rule economic growth is like 12 to 13% in nominal terms, and to that extent, we will see in next 10 years economy growing by 2.5 times. But what's more important is during this high growth phase, usually the countries have witnessed the manufacturing take a larger share. Right. If you notice the top two tabs, which is South Korea and Thailand, the average GDP growth was like 10%, close to 9 to 10%. And that was a pretty long period of growth, right? That was 1981 to 88 or 85 to 90. That is 5 to 6 years of continuous growth. For them, the manufacturing as a proportion of GDP went up from 22% to 28%. Very similar numbers for both these countries. If you notice the below two boxes, Indonesia and Vietnam, that is where ballpark we can fit in India, which is like 7% real GDP growth. We are on a base case basis, we are also saying that Indian GDP should grow at 7%. There are options and chances that it might outperform, but yes, for that, there needs to be proper execution. There needs to be adequate, proper government policies. The potential is very much there, but let us keep the upside and the option value aside. Let us talk about the base case of 7%. Indonesia and Vietnam grew for 8 to 10 years continuously at 7 odd percent GDP. And you can notice that their manufacturing as a proportion went up from 16 to 26%. So that is how we are also expecting that Indian manufacturing will also move in that similar manner. I'll elaborate on the reasons why we believe so. But that is how there are cross-country comparisons as well where they have demonstrated that kind of growth. So is manufacturing always a high growth sector for us? the answer is no. Last 8 years, if you notice, manufacturing has actually underperformed. So on the left hand side, the chart shows that the nominal GVA was like 10%. The manufacturing GVA just grew by 7.5%. It is just recently that manufacturing is seeing some sort of green shoots. So it is very recent phenomenon. So that to that extent, it is not a theme which is like running for years. It is something which is a newly developed new development in India, that the things are turning around for manufacturing. And in terms of proportion to GDP, we are at very low at 14%. Despite being the largest consumers, despite we having the huge pool of consumers in India, our proportion of manufacturing is way too low at 14%. We are service dominated kind of an economy. So 50 years back, we were agrarian economy that has gradually moved towards non-agriculture, but large portion of the shift has happened to the service sector. The manufacturing sector has trailed for quite some time. But if you notice, but what we are trying to say is on the right hand side, manufacturing eventually should take precedence from here on. It should start growing and it should outperform the nominal GDP growth, which was like 2.5 times. The manufacturing GVA will grow at 3.6 times. As I said, I'll elaborate the reasons what makes us believe this. So yes, there opportunities, of course, very big. There are competitive advantages, and government is also taking some initiatives and reforms. So we will elaborate on each of this portion. As I said, our consumption pool is very large. We spend around 60% of our GDP in consumption. If you notice, the growth in consumption is also very high at 10%. So that is almost matching your nominal GDP growth of 9%, 9 to 10%, what we saw earlier. So the consumption is big, the growth rate is high. So we have ready domestic market. So see, people are seeing rising income levels. So if I were to take you 30 to 40 years back, we used to import CKD versions of cars and eventually assemble it over here. Then gradually the automobile sector set up in India. There are various auto hubs now in India. We have seen not only the foreign participants coming into India, the likes of Suzuki's or Hyundai's and Toyotas of the world. We have also seen homegrown companies develop and flourish, the likes of course, Mahindra's and Tata's and Bajaj Autos and TVS. More importantly, if you see the ecosystem of the ancillaries, large portion of the ancillaries are Indian companies. Again, if I were to take you back to 1980s, people used to import televisions and VCRs. Right. And today we are manufacturing them in India. There is a proper ecosystem. So are we not capable in terms of manufacturing in India? The answer is no. We know manufacturing. We have history of manufacturing. Automobile is self-sufficient. Cement and steel, we are self-sufficient. We have textiles as a sector. Pharma as a sector which is exporting. So we do have export-oriented sectors like pharma, automobiles, chemicals, textiles. So we do have that manufacturing expertise. We do have IIMs and IITs in India, which is not a new phenomenon. Now, since the scalability will come, so we manufacture air conditions in India. So as then when the scalability comes, more and more electronics we will start manufacturing in India, the proportion will increase, the external reliance or the import reliance will decrease, and scalability of course will bring operating leverage to the industry. So we have of course now started to export as well. So there are reasons behind this. One, of course, is China plus one, which is benefiting India, and two, of course, government's the reforms and initiatives which are pushing the merchandise exports now. So it was a dull line between FY16 to 21. Now it has started to improve meaningfully. Where I say that the opportunity is large and we are just a sliver of the global market size. So what we have done is we have compared few of the industries with Indian market size with the largest market size in the world. The largest market are invariably either China or USA. So if I were to take example of say passenger vehicles, which is colloquially cars, we just sell 4.2 million cars, but the largest market is 20 million cars. We are just one fifth of that. You just assume that next 6 years up to FY30, the growth in that segment is 8% and the largest market doesn't grow. That is an hypothetical example. But if the largest market doesn't grow and we grow at 8%, then also we will just reach at 33% or one third. So if you notice across the segments, today we are either one fifth or one sixth or even one tenth in terms of critical products like pharmaceuticals. Despite being a large population, we just consume 8% of the largest market in pharma. So even after 8% growth, 6 years, 7 years down the line, we will just be 12%, and which will go up to 33% in case of cars. So the runway is very long. We have a decent runway of growth in terms of domestic consumption and penetration, and to that extent, the scalability will come in India as well. If you talk about competitive advantages, of course, there are factor of production which is required for country to be successful in manufacturing. If you talk about land, nowadays, because the land records are digitized, it is very easily accessible for the corporates to identify right land. Earlier, the companies used to buy land, purchase land, and they used to end up purchasing land in either ecologically sensitive zones or coastal regulatory zones, or either they are into some non-development zones. Now, because of digitization of land records, the corporate India can easily identify which are the developable lands, which are doable lands, whether it's an agricultural land or a non-agricultural land. Of course, you can see the physical document, but there are various issues. Once the records are digitized, it becomes much more easier for the corporate India and the land revenue authorities as well to allocate land. If you come to the second factor of production, which is labor, of course, we have a huge population and therefore a huge pool available, and that too at a very attractive cost. If you notice, we are even cheaper than so-called competitors like Malaysia, Thailand, Vietnam, or Philippines, which are also the beneficiaries of China plus one kind of shift in the global supply chain. China is 4 times the labor cost what India has, right? So on the margin, China also used to be very much similar to India 15 to 20 years back. But now manufacturing is very mature industry over there. China's GDP's proportion from manufacturing has also been very reasonable, 35 to 40%. That's the kind of range, and therefore that is very mature. Therefore, the manufacturing labor costs over there have shot up over the last 15 years, and they are now 4 to 5 times of what India is. So we do have that availability and the low cost advantage in terms of labor. If you talk about the energy cost, which are another relevant cost, many of the countries usually import crude oil or gas, including China. Right? Why I keep repeating China is that's the biggest competition in terms of manufacturing for us, either in export market or in terms of China dumping products into India. So that is why the relevant competition and comparison I keep making with China. See, of course, China and India depend on imported crude oil and gas. But on the margin, the world is moving towards green energy, which is wind and solar. If you notice wind and solar, the costs are very competitive in India vis-a-vis China. We are at a lower cost in terms of offshore wind, in terms of solar PVs. And by 2035, ballpark 35 to 40% of the power should be renewable. So we are competitive over there. Right. So our energy cost competitiveness is also there. Of course, in terms of developed world, we are very competitive vis-a-vis US, Europe, and Japan. But yes, vis-a-vis China also, we are incrementally on a blended basis, including the renewables. We are very competitive in energy. Next, you would require is capital. Of course, for a business, you require capital. The capital raised through equity markets, and everyone knows that the equity markets have been very buoyant. So the companies have been able to raise capital from the equity market. More importantly, if you notice the debt market, as I said, the balance sheets are anyways clean of the corporate India and of the banking sector so that they have revived the credit growth cycle. The cost also, we had that disadvantage that our cost of borrowing used to be very high. The GSEC, if you just see as a proxy, the GSEC in India was 7%, whereas in US it was just 2%. So globally, India's cost of borrowing or cost of debt capital was always very high. Has that come down? The answer is no, but the relative disadvantages definitely come down. Globally, the interest rates have moved up and the gap has been narrowed vis-a-vis Indian interest rates. So that is also helping India in terms of reducing the disadvantage. Finally, if you talk about the entrepreneurial talent, of course, for manufacturing, you need labor, you equally need entrepreneurial talent. There is no dearth of entrepreneurship in India. India is the largest startup ecosystem, the third largest ecosystem in terms of the growth in the startups. And on the left hand side, if you see the private ownership in the companies, the promoter ownership is like 44%. So the promoter ownership just denotes that yes, there are homegrown entrepreneurs which are running the show in India. And the private sector is the biggest sector in India, which followed by, of course, the government sector. So we do have decent entrepreneurship talent and pool also available in India. What has government done to it? Of course, added to it, as I said, there are many ingredients in place in terms of additional. If I were to put India's median age is like 30 years. That's the year when you start your career. That is when you start earning and growing right from 30 years to 55 to 60 years, the time you retire, either you do business or you do a salaried job or something like that. That's the golden period, the 25, 30 years where you earn and that grows disproportionately. So the 30-year of median age is also on the right side of India. Not only the incomes will grow, the consumptions will also grow up at a fast pace. So that is where we have ready domestic market in place. As I said, what government has done, let us see what government has done. Of course, everyone knows that PLI is what the government has introduced. Two very specific points to it. One, this is not a new concept. We always had subsidies, grants, and viability gap funding as a mechanism to promote industries or infrastructure. This is also something similar like viability gap funding, but more importantly, it's a production linked incentive. So you just cannot set up any dirty factory and take subsidies from government or grants from government. You actually have to manufacture over there. You need to give employment over there. You need to buy minimum proportion of designated thing from India. There are various requirements in various subsectors. So, for example, at least 20% should be procured from India, or at least 100 employees should be hired. So there are requirements related to this. So not only it has actually created factories, they are not ghost factories. They are actually producing. They are providing employment. They are procuring from India, and therefore after producing you take the production linked incentive, so that is a win-win kind of a thing, right? There are many sectors and subsectors across which the allocations have been given. Add to it, there are many state subsidies also. These are just few examples. This is not an exhaustive list, but there are many states also which do keep giving incentives for manufacturing. Further, big change what the taxation has brought out as the government has implemented, I think in 2019, if I'm not wrong, is the reduction in the corporate tax rate. Our corporate tax rate used to be like 35%, including all the cess and all that, which was like the most expensive tax burden in terms of corporates. Now, by bringing that down to 22%, we are equally competitive with other countries. And in fact, tad lower than few of the countries. More importantly, if you see on the extreme right, there is a 15% rate marked. few of the corporates, there was a small window that if you are setting up a new corporate with the new manufacturing operations from 2019 to March 24 window, you will get a 15% subsidized corporate rate. Now, it is just expected that in this budget, this sunset clause might be extended towards FY27 or FY28. Let us see how it manifests and how it eventually comes up. But even if that doesn't materialize, 22% now in itself is much more competitive in nature. Third thing, as I said, the fiscal deficit start of 2011 was very high and we had to continuously bring that down. So even after your global financial crisis in 0809, you saw the capex by the center and state government actually had come down, and that was in a very narrow range. This government tried to move up during its first tenure, but of course, because of all the events like GST and demonetization, the economy did not pick up and they had to eventually bring their capex down. Now, as I said, because of this pandemic, FRBM Act has allowed the government to spend, and the government has taken that advantage. Now you see the government spending is as high as 6.3, which nearly is surpassing your 2003-4 levels. This is the inflection point in 2003-4, where the economy had seen a huge run up in terms of growth. And of course, the share market returns were therefore very good, 2003-4 to 2008-9. So that is where the economy is today in terms of that inflection. If you talk about where the government is spending, what are the focus areas? Of course, infrastructure is the big focus area for the government. Economy, of course, has not grown by this 8 to 10 times in the last 10 years in real term and in nominal terms. But if you see the outlay in budget, 8 times or 16 times for railways and roads respectively, that is the kind of outlay this government has made. And one more important thing, what the government has done in terms of increasing the total addressable market, that is TAM, is we are the second largest signatories of free trade agreements. So there is an export market also which has been opened up by the government. Of course, the free trade agreements give the companies a duty-free access to other countries. So that is the advantage which the government has given. Of course, we may or may not be able to take advantage of this. There will be competition from other countries as well, and there will be execution related challenges. But yes, of course, there is an enabler in place at least now that the free trade agreements, we are the largest signatories after China. So in a nutshell, we have domestic pool of consumption. The government is also helping in its with all its means possible, and therefore we could definitely accomplish this the dream of manufacturing. We could also see what the other countries of our Asian peers have done, that the share of manufacturing will go up. Are there any outcomes related to that? So let us see what are the outcomes. Of course, we are the largest recipient of FDI in manufacturing after China. So that is of course the advantage what we have got. So that there are some success factors also which have come in. So till now it was of course narrative, but let us see how we are successful. Second, we are the largest beneficiary of shifting of global supply chains. Of course, there are relocations of global supply chains. Largest beneficiary is India. Is India the only beneficiary? It is only China plus one. The answer is no. It is China plus four or five. But India is amongst that plus four or plus five. And we are the largest beneficiary of this relocation. So that is also second, that is also which is like at the success factor, what we can see. Thirdly, if you see the share of capital formation from manufacturing, it was a very dull and a flat line from 12 to 20. Now it has also seen green shoots last 3 years that has started moving up. Of course, the 24 numbers are not available as of now, but definitely going by what the initial estimates and what we speak to people, that number has also moved up. So in short, the momentum has already started. Has it been a decade old momentum? No. But that has already been started. It is not a very new phenomenon, but we do have 2 to 3 years of now track record that we are building up blocks in terms of manufacturing. So if you notice in terms of your electronics, on a small base, of course, we are 3x vis-a-vis FY17 in terms of production. There are many new areas which we have added new in terms of local manufacturing. So of course, there are signs of early success. If you see mobile phones, now the exports have started moving up and imports have started coming down. Of course, on a low base, we have seen the exports going up. Over here also, you might say that we are not actually manufacturing in India, we are just assembling in India. Yes, we are assembling in India, but that's the delta. We never used to assemble also in India. We just used to import. Now at least we are assembling in India. Gradually, the Indian content will increase. The government will also not give freebies in terms of PLI without any incremental benefit to India, right? So they will require that incrementally you procure more from India. And with scale, it will be very logical for those companies also to buy from India. So in general, there will be procurement from India, there will be labor generation in India, and therefore the proportion of value add in India will continuously go up. Whether we will reach 100%, maybe not, because we cannot manufacture semiconductor in a scale what we are consuming, but we will at least start manufacturing semiconductors. At least 25 to 30% of the semiconductors can be made in India. Defense, of course, we are moving from import and buy global to buy Indian. That is what has seen the defense sector flourishing as of now. 70% is already make in India in terms of defense tenders. So as against 30-70 domestic import, we are turned the table to 70-30 domestic import. We have been exporting automobiles. So that is what I said. This is just an example, but we have been exporting chemicals, pharmaceuticals, textiles, automobiles. So we do have export capabilities in manufacturing as well. It is not just that we export IT and the services only. We do, of course, export manufactured products as well. And automobile sector is, of course, competing with China and Africa and other Latin American countries in terms of exports. So is this a sustainable kind of a thing? Yes, of course. If you notice why we say that it's a sustainable long-term story, because of course we are a fifth largest economy slated to move towards third largest in next 8 to 10 years. But we are way behind in terms of the per capita consumption or the per capita GDP. We rank 141st in terms of per capita. It's way below even Brazil or some of the smaller Asian peers as well. So the runway to grow is very large. If we talk about the GDP per capita GDP, we are largely an agrarian economy in terms of employment. Of course, in terms of the GDP mix, large portion comes in from services, but in terms of employment, we are still largely into agriculture. That explains very low per capita GDP. And if you notice, the per capita GDP per employee is just 1,65,000 in case of agriculture, but in case of manufacturing, it is like 4 times, 5,22,000. So if I were to put it in a nutshell, rising consumption, there is a requirement for the country to produce, or else we will have to rely on imports, which the government is against. And it is not very logical to import, right? There were huge customs duty on television imports earlier and on car imports earlier because government doesn't want the forex to flow out in a meaningful manner. So there is a requirement, there is a market, and therefore there is a requirement to manufacture in India. In terms of economics and terms also, it makes 4 times the agricultural per capita. Therefore, it makes sense for government also to push manufacturing. Thirdly, as I said, the median age of 30, of course, is an advantage in terms of rising consumption, rising income. That is also equally a liability as well, that this population or the pool requires employment. The government, see, the service sector is scalable sector. If you can sell 10 SIPs, you can sell 100 SIPs also. You might not require 1:1 kind of employees. But if you talk about manufacturing, if you are manufacturing 10 mobiles, you will require two people to manufacture 20. You will require 10 people, if not 10, at least 8 people to manufacture 100 mobiles. So manufacturing is one-to-one correlated. And that is therefore can provide employment to the huge pool what we are talking about. So if we don't capitalize on it, then the 30 year of advantage will be lost for India. So that is also imperative on the government to push manufacturing in terms of providing employment, generating taxation, and in terms of GDP, overall GDP growth as well, in terms of reducing your import dependency as well. So there are various aspects where the government is also required to push manufacturing. So in that broad context, now let us see how we will be approaching this manufacturing as an opportunity. So we internally have categorization as a process, which in short or in a colloquial language, we can say that it's an approved stock kind of a framework. We do have lengthy in morning meets, lengthy discussions, and then we approve the stocks. There are just 270 stocks which are approved out of more than 2000 stocks which are listed in India today. Out of that 270 stocks, ballpark 150 is the number which is eligible for manufacturing. Out of that, of course, there are traditional sectors, as I said, which is like automobiles or pharma, textiles, capital goods, consumer durables, and we have new age sectors. We might not manufacture electric vehicles, but there is an ecosystem which is starting to build up in around electronic vehicles. Of course, the castings, the electronics related to that. So to that extent, we have EV or EV related opportunity, batteries, semiconductors, defense, electronics, renewables. If I were to add up few more sectors, we have chemicals in place. We have contract pharma manufacturing, which is new age sector, which is gaining momentum. So we do have traditional as well as new age sectors. Our preference will be largely towards the new age sectors because those are the fast growing companies, those are the fast growing sectors. The traditional sectors, of course, will give you some anchoring and in terms of the replication of your nominal GDP growth, but the new age sector can grow at 1.5 to 2 times your nominal GDP. What we are trying to make is a 50 to 60 stock portfolio, and our preference in terms of companies will be the companies which are globally competitive. Why? See, if you want to restrict imports, substitute imports, or create an export market, then you need to be globally competitive. In short, you need to have a return on capital employed of at least 20%. That is where you are ballpark a globally competitive firm. Or you need to have technological prowess. Unfortunately, in India, only in terms of listed companies, it is largely the MNCs which have this kind of technological prowess, the likes of ABB or Siemens or Honeywell. Of course, these are examples what I'm citing, not one or all will be part of our portfolio, but these are the kind of drifts what we will try to make in our portfolio. And third will be the sectors or the companies which are having very, very strong tailwinds. It could be either strong demand tailwinds or cost tailwinds or some sort of new PLI coming in for them, some sort of strong tailwinds which is visible for next 2 to 3 years. So yes, this tailwind sectors can be a rotation kind of a thing, but globally competitive and technology prowess, those two buckets will form 40-45% of our fund, which will be the core. And we will keep shifting and actively managing the companies within the tailwinds. Right, there will be different sectors which will or different companies which might have tailwind today or headwind tomorrow. So that will be a non-permanent kind of a portion, which is like 45 to 50%. Is this theme very broad-based? Of course, the answer is yes. It is not a very narrow theme. If you talk about automobiles or pharma or defense, those are very narrow themes. But manufacturing is omnipresent. It is very broad. Generally, if we go by jigs, you can see automobiles, auto banks, consumer durables, aluminium, steel, cement, capital goods, industrial, pharma, consumables, refining, petchem, everything. So it touches not only industrial goods but consumption goods as well, right? So it can vary across. So that is where you have a broad opportunity and a well diversified set. So it is a broader theme and not a very narrow theme. And of course, it will have its own cycle, which will replicate your economic cycle, but it will not have a very narrow cycle related to a one specific small sector, like say automobiles or say pharma. It will have a very broad economic cycle. On the right hand side, if you look, out of our 146 stocks which are eligible for manufacturing, only 33 are large caps. And that is not that we are not categorizing it. It is the outcome of where our economy is. We are only 14% in manufacturing, and therefore we have not created much large caps in manufacturing. It is restricted to automobile, steel, cement, and few other capital goods. The large portion of manufacturing sits in mid and small cap, and that is where our portfolio will also be focused on. So we don't want to choose mid and small caps, but the opportunity only lies in mid and small caps. We will have around 60-65% exposure in the mid and small caps and 30 to 35% exposure in the large caps. We don't want to make it a theme which will be large cap focused, or else it will just replicate your GDP growth. What we want to offer is very high growth, new age India manufacturing. That is what our idea is. What can change this portfolio or our ideology towards it is a economic slowdown, which of course we are not foreseeing in the near future, in the near 5 to 6 years. But if at all uh, we are hit with the economic slowdown, then we will of course move towards large cap. But in today's economic setup, where the economy is in terms of cycle, we will be owning 60 to 65% mid and small caps. It will be mainly the new age kind of companies. New age in the sense the companies might be old, but they are drifting towards new age, either in terms of renewable energy or electric vehicle, or the new other the opportunities are new, like defense, railways, and so on and so forth. Has the market realized the opportunity in manufacturing? If you see on the extreme right side, since 2005, the manufacturing was almost an equal performer in terms of the broad market. So it is like not a big difference, 16.5 in terms of manufacturing TRI versus 15.5 in terms of Nifty 500. But you look on incrementally on the left hand side, the market has incrementally recognized that manufacturing is going to be our future. This is the only sector which can help economy to grow at 7.5%. This is the sector where you can have tax buoyancy and the taxation can improve. This is the sector where you can generate employment. And this is the sector, therefore, to satiate our increasing consumption requirements. Right. So the market is also recognizing that and has rewarded manufacturing. Having said that, this is again a traditional oriented index. Nifty India manufacturing is 80-85% large cap and more towards traditional sectors like steel, cement. So the likes of Ultratech or Tata Steel or Larsen or Reliance, that is the kind of stocks they have. Again, what we're trying to say is two things. We will not gravitate towards the traditional sectors, which are anyways growing in line with your GDP. We want to give something which is growing at a much faster rate, and the runway of growth is very large. That is the kind of sectors and stocks we will be inclined towards. We will be very specific in terms of companies which are purely into manufacturing and no allied activities. If I were to elaborate, see, power, for example, cannot be said to help manufacturing. Yes, power is required in manufacturing, but power is equally consumed in households by agriculture, by the commercial establishments. So power is not just driving manufacturing, it drives many other things. Banking. Banks do lend loans for setting up factories and setups, capacity expansions. But banks also give retail loans, right? IT gives software, SAP or various other softwares to the manufacturing organizations, but it equally gives to retail and banking as well. So what we are trying to say is we will be looking at companies which are pure focused on manufacturing, no allied or ancillary things. Power utilities, if I just go back a slide, power utilities are not part of our opportunity set. EPC companies might not fall into manufacturing. EPC companies not only construct factories, they do construct roads also. They do construct highways and bridges and ports as well. Right. So, and dams or various other things. So EPC companies or utilities or banks, we will not have any shallow proxies. It will be very sharply focused. We will not have FMCG companies. I will take Hindustan Lever, for example. We will not have Hindustan Lever. Hindustan Lever doesn't manufacture. It just white labels. It outsources manufacturing to others. If those outsourcing manufacturing companies are listed, and if that makes sense, we will buy them. Right. So we will not buy white label companies which actually do not manufacture. They just are marketing companies. So that is the kind of opportunity what we will be looking at. Very sharply focused on the adjectives. If you notice, India, high growth, new age manufacturing. So it needs to be necessarily Indian companies focusing on India's consumption or exporting from India, or they need to be high growth and they need to be in largely in the newer age. We will of course balance the portfolio with some large caps and traditional companies for overall balance to the portfolio, but 60 to 65% will fit into this, the adjectives what I have mentioned. So yes, in summary, what I'm trying to say is yes, we are now in an era of rapid economic expansion. Manufacturing is not only an opportunity but a requirement for India. So in that context, we are launching this fund, which would of course open on 25th of July, and it will be open for subscription till 8th of August in the NFO window. Yes, so thank you for patiently listening to me, uh, and I'll be happy to take questions now.
Yeah, thank you, Mr. Kothari, for explaining this entire NFO strategy in detail. You also nicely covered up upon the government policies, how it affects the overall our manufacturing sector, and the strategy which you shared was very sharp, and it really gave us a good understanding as to how the fund would be positioned. So as you said, now I would like to share the questions in front of you, which our audience has requested for. So allow
Sure.
me a moment to set up. It would be on a PPT, so which I would like to share.
Yes, so I've given you the control. I'll just stop sharing. You
Yeah,
can,
please.
yeah. Yes, your PPT is up on the screen. So should I start answering? Am I audible? Hello.
Yeah, Nimant, you are audible. I
Okay,
think
I
Mr.
think
Kamlesh. Yeah,
his
yeah.
connection was lost, I see.
Yeah, sorry, I just lost the connection. Can you see the screen?
Yes, so I was actually checking that the PPT is already on the screen. So should I start answering these questions?
Yeah, please.
Yeah, sure. So the first question, of course, reads out as how is manufacturing fund different from other sector specific funds? Manufacturing actually is not a sector; it's actually a theme, right? We colloquially call everything a sector. Sectors are usually small sectors, which are like automobiles, pharma. Manufacturing encompasses various industries, as I showed in my PPT, right from steel, cement, automobiles, consumer durables to various consumption goods to capital goods, industrial consumables, anything and everything you manufacture comes in manufacturing fund. So it is, of course, a very broad based and a diversified thing. One particular industry going down will not materially impact. More importantly, this is a theme where the government is focusing, right? So that is where we are coming this as a theme, or else we would have come up with individual sectors. Of course, sectors are much more sharper, and in terms of the thematics, they are much more sharply focused. But manufacturing, why we choose that as a theme is like because it is where the government's agenda is, right? So that is where the offering fits into the current scheme of things.
Thanks. Yeah, next question, please. Uh,
So what are the key
what?
performance indicators to evaluate the manufacturing funds? Nisi, of course, what we are aiming at, that is also what I told you, that what we are aiming is that the companies give you earnings which are superior than the broad market. That is what your portfolio should give you if you are focusing on a theme. Right, if you are ending up with a nominal GDP growth, or say if you talk about BSE 200 or NSE 500, if your earnings are very much mirroring them, then there is no point in getting into thematics. Thematics are usually invested as a satellite to the diversified fund. So usually you have 70% diversified and on a thumb rule basis 30% in thematics, just to take advantage of fast growth in those sectors or themes. So the important thing is the portfolio should ideally deliver you a superior earnings outcome. What we have created in terms of our model portfolio EPS growth for the next 2 years, according to the Bloomberg estimate, is 28% CAGR. So that of course needs to deliver that, or else there is no point in getting into thematic and taking a very narrow risk. Right, we are better off in diversified. So that is what the biggest differentiation should be in terms of any thematic. So for example, I run PSU fund as well. We have been talking about investing in PSUs because they will see big delta. We have been selling that since say last 3-4 years. We had anticipated huge delta in terms of PSU earnings outcome, and that has been delivered as well. And that is the biggest advantage you invest in any particular theme. So I hope I answered the question. We
Yeah,
can
sure.
take next.
Next question. So, how do manufacturing funds typically perform during different economic cycles? So, uh, we generally see different cycles. So, will there be a kind of an underperformance during certain cycles of the year?
No, of course. So if there is a very sharp slowdown, of course, manufacturing will also slow down, because if consumption slows down, manufacturing slows down. So there will be some impact of the economic cycles for sure. But having said that, because it is encompassing various things, right, from industrial capital goods, industrial consumables to consumer goods like automobiles, consumer durables. If you talk about various alcoholic beverages, they are no way related to the economic cycle, right? So there are various different subsectors or industries within that which may or may not follow the economic cycle. Alcoholic beverages follow their own cycle. Export related manufacturing follows its own cycle, whether the global macroeconomy is good or not. Steel follows again the global commodity cycle, but cement is very domestic oriented commodity. So yes, broad economic cycles will have a bearing on the funds, of course, but it will not be very sharp, right? Because the manufacturing again, as I'm saying, it's a broad theme. It encompasses consumables, consumption, as well as capital goods and exports and local consumption. So it is like all encompassing. So some or the other sector will do relatively outperform, not in terms of stock price, of course, but in terms of actual consumption or actual growth. Some or the other sectors will outperform. Today, suppose the rural is going through a slowdown, might be possible that during different economic cycle, the exports might suffer, the urban consumption might suffer, but rural will see a good demand. So yes, even there also there will be different outcomes. So yes, this to some extent will of course mirror your economic cycles, but it will not be 100% mirror.
Sure. Thanks. Moving to the next question. Can you provide examples of historical performance trends for leading manufacturing funds? Generally, this is happening here in India also and global. So, any examples if you have for historical performance, how the trends have been? It is related with the previous question, wherein actually the customers, the partners are little sensitive, feeling ki like during a particular moment, if the funds dip at every year kind of a thing,
Mhm.
probably it would be a challenging scenario for the customers if they wish to exit at that point in time.
No, no, sure. So as of now, I don't have handy in terms of historical performance and specifically for global peers. But what I had showed you in the last slide was Indian manufacturing as an index has performed in line with the broad market since 2005. That is last 5 years that the manufacturing index has started to outperform. So it is a recent phenomenon. The government attention towards manufacturing, it's a recent phenomenon. We have never focused materially on manufacturing. We had always focused on agriculture, or we had focused on services as a sector, and therefore services have grown up multifold. Manufacturing has incrementally gained importance in India. So that is
Correct.
just the start point of it. And it is a very recent phenomenon, therefore, that manufacturing as an index has started to meaningfully outperform. Uh, Global comparison, frankly, in terms of how those funds have performed, frankly, I don't have it handy.
Sure. Thanks. We can understand it was an flash question asked by one of our audience. Going to the next question, what are the current trends in the manufacturing sectors that could impact mutual funds focused on this industry?
Okay, right. So broadly, our PPT did cover largely what is happening in manufacturing. How is government looking at it? How are the taxation rates changed? How is the macroeconomy behaved in terms of how the manufacturing has grown vis-a-vis the other broad economy? So of course, I think I managed to cover this, but is it anything what I can add? I am not very sure what exactly I could add on to this.
Sure, our audience will have an opportunity to go through this entire session again if they wish, as it will be available on YouTube also. So we'll move to the next question in that case.
Sure.
So how do global economic factors influence manufacturing funds?
Sure. So
Broadly, you have covered this also, but yeah,
no, but
sure,
yes,
for the
let me
yes.
again answer this. This if there are some industries where which are very locally or which global factors don't influence. For example, cement. It's a very domestic oriented commodity. But if you talk about steel, the international steel prices do dominate. Of course, for cement as well, there are international coal prices which do affect their power costs. But again, if you see the local demand is good, they can able to pass on the rising power cost to the consumer. So if you talk about alcoholic beverages again, they have nothing to do with global economy. the local excise duty changes dominates the price movements in terms of the alcoholic beverages. If you talk about rural economy, again, it is shielded with the global factors. But in terms of various other factors like automobiles, the input cost is steel or aluminum. The global economy will have a bearing on that. The export oriented sector, again, pharma or chemicals, where global trade is relevant or the global pricing demand supply is relevant. That is where it will have the bearing on the local companies, right? So it will depend on company to company whether it is domestically focused or export focused, whether the inputs are related to the global economy or not. But we have a fair mix, not just I'm talking about Invesco as a fund, but in manufacturing we do have a decent enough blend in terms of companies which are both isolated and very insulated from the global economic shocks. And there are various companies which will definitely face this. But to mitigate this, as I said, where we will be focusing on is cost competitiveness. If they are globally cost competitiveness, there will be cycles. But globally cost competitive companies or leaders will navigate through these challenges. But yes, there will be various companies which definitely will face global shocks, and there will, as I said, there will be companies which will not be related to anything to do with your global economy.
Sure. Thanks. Moving to the next question. How do manufacturing funds select the companies they invest in? Any specific strategy they follow?
Sure. So see, if I were to look at the peer set, and there is no right or wrong into that, they are largely large cap oriented and very much close to the index hugging kind of a strategy. One fallacy in our index is the largest weight is Reliance Industries, 5.5% in the Nifty Manufacturing Index. Now, Reliance, in terms of the total market cap or the enterprise value, it is not manufacturing company. Only ballpark one third of the value comes in from the manufacturing related activities like refining and petrochemicals. Another two thirds is coming in from retail and telecom, which is not manufacturing. But our index has highest weight in Reliance. We will not be inclined to buy Reliance unless it eventually maybe or may not demerge it and become again a petrochemical and a refining company. Reliance doesn't fit our bill in terms of the 146 companies I showed you, which we feel which are eligible for manufacturing. Two more companies, Larsen and NTPC. They also form decent chunk of index, but we do not see it as a manufacturing opportunity. Those are well diversified. Power is well diversified. Even if you talk power in terms of manufacturing, power is not manufactured. If you look at excise definition, central excise definition, power is generated. It is not manufactured. And therefore, there is no excise duty on power, right? If you talk about
Correct.
end users, as I said, power is consumed not only by manufacturing, but by agri and households and commercial establishments as well. So you cannot, it's a very shallow correlation of power and manufacturing. We will buy companies which are manufacturing power equipments like BTG or transformers, rectifiers, or power grid kind of companies. So which manufacture the capital goods, not the power grid as a company, but the equipments related to that. So we will still be focusing on manufacturing of those capital goods, but not power utilities as such as companies. What we will be trying to offer is purely, as I said, manufacturing. So accordingly, investors can look at the peer set portfolio, the index, and then take a call whether they are what they are getting into, what they are getting as a portfolio. And of course, they can make that choice whether they want to stick to the traditional manufacturing in India or they want to be part of the new age companies which we are trying to create a portfolio of. So that of course I will leave to the investors to choose from. As I said, there is nothing right or wrong into it, but logically the traditional sectors will of course offer only nominal GDP growth. There are new sectors which are emerging, which are sunrise sectors, which can grow at 2 or 3 times the nominal GDP, and therefore have a long runway of growth as
Right. Thanks.
well. Thank you.
Uh, Another question is what is the future outlook for manufacturing funds given the current economic and market conditions?
Right, very nice question. I would say I will break it up into two parts. Economic conditions are very robust. As I said, economy is usually driven by balance sheets. It takes 8 to 10 years for spoiling the balance sheet and 8 to 10 years to repair the balance sheet. We had 2002 to 2010 where we gradually spoiled the balance sheets. Early part we were growing nicely, and last 4 5 years we got into over leverage. Then it took an entire decade for the banks to correct their NPAs. Currently, we are on the left side, that is like 2011. On the economic cycle wise, we are just at the brink of starting a new upcycle. It has already started 1 or 2 years, but yes, we are still at the early stages. Yes, so I don't find any visible challenges on economy in terms of the next 4 to 5 years or 6 years. Why 5 6 years? Because there is always a change in government. There are elections, and there will be some bit of policy changes around that. That is where I said 5 years. If there is a continuity in the government and the government policies, we do have 15 to 20 years. But if you come to the second part of it, the market conditions, yes, today the market valuations are at the higher end of the long term averages, right? What we are trying to we will try to mitigate over here is by offering two three things. One, 50 to 60 stock portfolio, which is very well diversified. We will not take a huge position in single stock. That is where we will try to diversify. We will try to be on the right side of the government policies and the industry tailwinds. That is very relevant. And because it's a mid and small cap oriented portfolio, that is where a very wide kind of a 50 to 60 stock portfolio, right? Or else we would have created 35 40 stock portfolio. Secondly, we don't know what's the current agenda of the government, where the government will in this budget focus, what will be the immediate agenda of the government. It might be defense, it might be railways, it might be something else. That is where again the 50 to 60 stock portfolio will help. See, all the stocks will have long-term runway of growth, but yes, the near-term factors also do matter a lot for the near-term stock price performance. That is where we will try to diversify. More importantly, mid and small caps are not time tested for 15 20 years, right? Again, that is the logic that we have not seen a 15 20 year cycle for them. Few of the companies are newly listed as well. And again, that brings me to the same thing that we will diversify and have a 50 60 stock portfolio rather than having a 35 40 stock portfolio. And finally, in terms of market conditions also, we would recommend that one, two, three thumb rules. One, as a thematic, it need not be more than 30%. 70% need to be in the diversified portfolios. It should be restricted in terms of a satellite positioning, in terms of like 30 to 35%, not more than that in manufacturing. And two, it would be a very good idea to put 50 to 60% lump sum and the rest 50 to 40 to 50% as STPs over next 5 to 6 months. SIP always is a good idea, of course, but even if people are looking to put it upfront, I would say 50-50 can be a good kind of a thought process, that 50% as lump sum and 50% as spread out over next 6 odd months. That could be the navigation which could be taken in the current volatile and highly priced market situations. Of course, what we will also do is we will also take time, 30 to 40 days in terms of deployment. So that also will be very gradual as well, right? So you will have that time in terms of averaging as well. We will also have time, and 5 6 month STP will allow you that averaging as well. So yes, it is a long-term opportunity, but yes, entry points are very relevant, and that is where we are trying to say that we can kind of do this averaging for next 5 to 6 months, and that could at least take care of your current elevated valuations.
Sure. Thank you. Thank you, Mr. Kothari. So thanks. These were the all questions we had for today evening. So I would again like to thank you for sharing your detailed view on, taking us through the entire presentation, sharing us your insights, your thoughts on the world and Indian economics, government policies, how it is impacting the manufacturing sector, its competitiveness, how it is increasing, and how your Invesco Manufacturing Fund will be working and explaining as to how investing in this upcoming proposition could be of a great value for our, of course, business partners and their customers. So I would like to thank you again for making time to come over here and making this, program possible. And of course, thanks to your team also for all the logistic and background help they have extended. And all the very best for this ongoing NFO. Thank you.
Thank you, Kamlesh ji, and thank you everyone for patiently listening me out. Thank you, Team Invesco.
Yeah.
Good day.
Yeah. And dear business partners and my colleagues, with this, we have come to an end to one more interesting session. I hope you all enjoyed listening to Mr. Kotari and will make the most of this opportunity. In case if you wish to listen this session again, you can visit our YouTube channel and listen to this and our previous sessions again to your benefit. Don't forget to subscribe to our channel too. For digital stationery, logistic, brokerage, or any other requirements you may have, our sales RM at the ground would be happy to help you. So I thank each one of you and for joining in, and I wish you all a great day and a happy weekend ahead. Thank you. Thank you. And on this note, we close this session. Thank you.
Thank you so much.
Thank you.